What is going on, investors? Hopefully guys are doing well out there. That is right. It is Friday. It's time for the weekend. But more importantly than that, it's time for the FAANG Stock Recap Show here on the Investor Channel, where every Friday we recap all the major news and the technical chart patterns from all the major FAANG stocks, including Microsoft and Tesla. And this week we had earnings from NVIDIA, but we kick things off like we always do with Meta Platforms. Started the week at $112, ended the week about $1 lower at about $111 per share. This is after Mark Zuckerberg told his employees, no, it's not the business model that we're spending tens of billions of dollars a year on. It's actually going to be WhatsApp and Messenger that is going to propel revenue growth for Meta into the future. This obviously comes on the heels as the company planned to cut 11,000 workers over the week. And as the social media sites are seeing that Twitter is still up and running after firing the vast majority of their employees. My guess is, Mark, if you grew a pair, you'd probably be able to fire a few more people over there. Now, Meta Platforms has fired dozens for hijacking user accounts. It's another reason why maybe having a bloated employee base, not necessarily a good thing, as these employees took bribes and in other cases took over users' accounts maliciously. Meta Platforms is exiting some of their business models, including that portal, which was kind of like a screen. I didn't see much use for that when people have iPads and phones. They're also exiting a smartwatch hardware project, which obviously has a lot of competition from Google, which owns Fitbit, and obviously Apple as well. My guess is this company within the next 12 months will be cutting back tremendously on their AR and VR goggle project as well. Moving on to Apple, start of the week at 148, end of the week up about 1.75% to $151 per share. But this is as iPhone wait times seen hitting the high end of extreme levels. This is not only in other countries, but here in the United States. And I kind of tested this theory. So I created a phone on Apple's website. This would be an iPhone 14 Pro Max with 256 gigabytes of space in a black color. And I'm just buying it outright for $1,200. And it would not get here until actually after Christmas, 3 days after Christmas to be exact. So obviously negative for Apple, probably in the shorter term, this most upcoming quarter, probably a negative. Will people trade down to something else, or will people that are giving these as gift or expecting them as gift being willing to wait till after Christmas time, as it does look like the wait times on these phones has pushed back? Obviously, that's kind of a good thing and a bad thing. It's showing you there's probably a significant amount of demand for these phones, but obviously the supply chain is really messed up over at Apple. That's after a manufacturing partner called Foxconn paused hiring due to limited quarantine space. Boy, they're having all types of problems over there in China. We'll have another story here where Apple needs to pivot away from China in terms of its manufacturing and eventually its exposure to that chip space as well. Apple is launching its first MLS streaming service. They obviously bought these rights. It wasn't that long ago that we did a story on this. They have the exclusive right to air virtually all MLS regular season games. There will be some simulcasting on other networks, but it appears that service will cost either $14.99 per month or $99 per season. If you have an Apple TV subscription, you will get a discount. It's either going to be $12.99 per month or $79 per season. I tell you what, if you look at the price of NBA League Pass or certainly NFL Sunday Ticket, well, that is a bargain if you're an MLS fan. Now, Apple CEO Tim Cook said the tech giant will have to start sourcing chips in its all-important phones and other products from Arizona by 2024. This is after Taiwan Semiconductor, which received a pretty big investment and really an endorsement this week from Warren Buffett. That company is currently building a plant in the Grand Canyon state of Arizona. That is expected to be completed by the year 2024. Intel obviously also in the process of expanding a plant in Arizona as well. But just keep in mind, they actually partnered with another company called Brookfield Infrastructure Partner, and that company is investing $30 billion into that site, and the two are actually going to split profits. Tim Cook said that 60% of the world's processors come from Taiwan. That obviously gives you a little bit of China risk, but also just geographical risk in general, and we've seen with the supply chain, not necessarily that good. And Tim Cook said, regardless of what you may feel or think, 60% coming out of anywhere is probably not a strategic position. So finally, these CEOs are waking up to the fact that maybe producing things at the lowest possible cost comes with other risk, and they're certainly feeling that when it comes to the supply chain. Moving on to Amazon, start of the week at 98, ended the week down to $94 per share. That's about 4.7% decline. This is after Amazon said that they plan to lay off about 10,000 employees. Now, the company has over 1 million employees, but a lot of these are obviously your kind of blue collar workers in those fulfillment centers. And my guess is the churn and the turnover in those fulfillment centers is relatively high. This is actually going to be roughly 3% of the corporate employees. And as a proud shareholder of Amazon, I totally applaud this. I would not cut back on the warehouse staff, on the delivery staff. These companies have gotten bloated from a corporate perspective. A lot of these employees make way too much money and really don't contribute a whole lot. So we're seeing this across the whole tech ecosphere, and I think it's a good thing for shareholders. Now, Apple's CEO says that role eliminations will extend into 2023. Well, I tell you what, Mr. CEO Andy Jassy, grow a sack like Elon Musk and just kick these people out the door. I know Elon's taking a lot of heat for that, but instead of being all nice and politically correct, let's just get these people out the door. The company exists for shareholders, and we are in this company for profits, not for the feelings of overpaid corporate workers. Amazon Web Services stretches its hiring freeze into the first quarter of 2023. Not necessarily a good thing when the most profitable and the fastest growing business segment of the company, they're doing a hiring freeze there. I'm a little concerned about what the AWS numbers are going to look for in subsequent quarters. This is after AWS launched an infrastructure push in the country of Spain, and they're going to invest over $2.6 billion over the next 10 years. They're going to have roughly 1,300 full-time jobs in the country. This is where the growth is going to come. You're pretty much tapped out here in the United States. Yes, there's still market opportunity, but you have so much competition when it comes to AWS from Google, and when you have Microsoft and certainly others in this space, it is going to come overseas. One Medical, which Amazon agreed to buy earlier this year for about $3.9 billion, is going to receive $300 million in financing from Amazon in $30 million per month tranches beginning early next year. As that deal is waiting to be closed, they're going to earn a small interest rate on that. That is also after Amazon. We've talked about this on the show, but the company, and certainly Andy Jassy, has talked pretty extensively about how the company is going to try to make a bigger push into healthcare. Well, we've got a little bit of window into what they're looking for. They're going to offer Amazon Clinic for common illnesses. Now, this is not going to be something that accepts insurance, but if you need a prescription, you need some kind of medication, it looks like you're going to be able to run that through a pharmacy, which will be able to bill your insurance for that medication. Currently, this will be offered in 32 states, but again, this is going to be for very common illnesses, probably colds, headaches, those types of things. Now, also, Amazon Clinic is going to be seen putting pressure on the telehealth services Hims and Hers, and also Teladoc Health. I tell you what, wouldn't want to be a shareholder of either of those companies, as it appears Amazon's knocking on the door of that business model. Moving on to Netflix, start of the week at $2.92. This thing's been on fire, but took a little bit of a breath this week, down about 1.5% to finish the week close to $288 per share. This is after Bank of America said that Netflix shares should continue to head north as they have a strong runway for subscriber growth. It certainly looks like all the changes over at Netflix have been working out relatively well, at least from a shareholder perspective. Moving on to NVIDIA, start of the week at 161, end of the week down about 4.7% to finish the week closer to 154. This is after reporting earnings earlier this week. You can view our channel on our in-depth review on the earnings, but revenue came in at $5.93 billion. That was a decline year over year of 16.5%. They also gave us Q4 guidance where revenue is expected to come in right about $6 billion. Consensus was actually a little bit higher on that as well. So I tell you what, when you start looking out at the revenue estimates into the future for NVIDIA, you were looking at 2 more consecutive quarters of actually negative revenue growth and also negative earnings growth as well. But Wall Street is anticipating in the second half of next year that sales growth will resume positive, and then it will rapidly reaccelerate actually towards the back half, really in the month that we're in of 2023 and into calendar year 2024. I don't know if that'll materialize, but we'll certainly be here on the channel to cover it. Now, initially, NVIDIA was actually up on the news of their earnings, but started to give those gains back as I think investors are starting to digest. This company is worth $400 billion. That's a 48 forward price to earnings on this one, and that's if those earnings don't continue to get walked back. And you're looking at a company that's trading well north of 17 times sales. But analysts believe that we should have a bottom in the gaming sector revenue, which I don't have up here, but was basically cut in half, not year over year, but actually sequentially. You saw that business cut in half, but obviously NVIDIA rolled out new products. So the gamers out there probably waiting for that. NVIDIA and Microsoft are going to partner to build a massive cloud AI supercomputer. This is going to involve thousands, maybe even tens of thousands of GPUs. My guess is this is probably going to be low margin to Microsoft. That's why these giants kind of partner together. Microsoft gets kind of some preferred pricing, and NVIDIA is going to give them the preferred pricing because it probably gives them a little bit better volume discount that then they're going to be able to charge other consumers and maybe other server makers out there and make the margin back on other deals. That's just how I see that deal. Moving on to Google, start of the week at 95. This one actually up 2.3%, finished the week at 97.43. Activist investor urged Alphabet, which is Google, to cut cost and boost its buyback. I tell you what, this company is buying back the shares a tremendous amount over the past couple of years, but this activist investor wants more. And I tell you what, Alphabet can absolutely cut costs. I saw people flipping out yesterday on Twitter, the fact that like 90% of the employees walked out the door. What Elon Musk is going to prove to the world is that these websites and these apps don't need thousands of employees there drinking soy lattes and avocado toast. Google is going to pay a record $391 million fine to states in location tracking probe. This involved 39 states out there, and this dates back to 2018. Other fines for Google as an Italian court rejected a Google appeal over a fine, and they accepted a plea deal from Apple. These fines, I think for the two companies combined, total about $10 million all in all, essentially a rounding error on the cash balances both those companies have. Google looked to pay Activision Blizzard and others to stop App Store rivals. That is according to Epic Games in a lawsuit. Google agreed to pay $360 million to Activision Blizzard at one time in order to block the development of a competing app store. Now, $360 million to Google, not necessarily a lot of money. $360 million to Activision Blizzard actually is relatively significant. YouTube is going to bring shopping features to YouTube Shorts in a new search for new revenues. I saw on my creator profile or my back end of YouTube, it looks like the Shorts platform, it looks like you're going to get monetized on that, I think sometime next year, like in February or March of next year. So I would expect a lot of people to push those Shorts videos now that you probably will get paid for them at some point. And then if you could add shopping features to them, I don't know how effective those will be. Like a 60-second ad, am I going to really see a t-shirt a guy has on and click it and buy it? I don't know, but Google obviously experimenting with new features here on YouTube. I would expect a lot of creators to pump those down your throat, trying to get you to buy something. Moving on to Microsoft, start of the week at 241, ended basically flat right at 241. That is after China is said to reject a simplified filing request for that review of Microsoft planned Activision deal. We are just going to continue to roll down the regulatory burdens that countries and governments put on Microsoft to see if that Activision deal eventually goes through. Again, this deal has a $3 billion breakup fee, which I think would be good for Activision. I don't necessarily think at this point it would be negative to Microsoft, since the general consensus is Microsoft paid a premium, a big premium for Activision Blizzard. Moving on to Tesla, start of the week at 189. This one just keeps sliding down the road, down 5% to $180 per share. This is after Tesla recalled 30,000 vehicles due to an airbag issue. This is for 2021 through 2023 Model X vehicles. Those are the premium vehicles. And it looks like there's a problem with the passenger airbag deployment. This will be an over-the-air software fix, so Tesla's not going to have to bring these into service centers anytime soon. Elon Musk has someone in mind to run Tesla in the future. I don't know why this made news. Almost every company, especially ones that that are worth $590 billion have some kind of succession plan in place. Now, Tesla could be a value stock by the time the Twitter turmoil fades. According to Morgan Stanley, he says that if Tesla's stock tests the $150 bear case, look, we're like $30 from that price target. He said that would put Tesla at 12.5 EV to EBITDA and 23 times 2025 price to earnings, a level Morgan Stanley would say that provides excellent value for a self-funded, essentially no debt, cash flow positive, 20 to 30% top line grower. I couldn't agree more. You've got NVIDIA that is putting up negative sales growth and producing very few earnings. And you have a company like this that's not valued that much more from a market cap perspective, but certainly from a price to earnings perspective, getting hammered. Certainly with interest rates ticking up, that can impact demand for these cars. But the Tesla buyer tends to be a little more resilient. And also Tesla could invest in different types of financing incentives. More people could go over to leasing these cars. So there's some alternatives. If auto rates stay 7, 8, 9, 10%, Tesla could do some things, especially with their cash on the balance sheet, to subsidize the cost and purchases of their main product. Moving on to the technical segment of the show, we've got the S&P 500 here. Looks like it's trying to make one final push, maybe to the top of this pattern, which would really just be another about 2.8% higher, right about, we'll call it 40.80 on the S&P 500. If it does that, we are expecting this one to give back a lot of the gains. Again, technical analysis is really more, I think, more technical patterns. All year, you've been making a series of lower highs in lockstep. It would very much make sense that this rally peters out in the next 2% and then gives it all back, and at the very least, retest the lows that we made back here in June, maybe potentially retest the lows we made back here in October. And if this technical pattern is really intact, you are going to retest the bottom of the channel, which would take you really low on this one, probably at least lower than 3,400 on that one. That would be a great opportunity to continue to dollar cost average for the long-term investor. Moving on to Meta, we've got to zoom in here. This one did something interesting. Obviously, after earnings, this one took a gigantic gap down, okay? But what's interesting is this one's actually got back into the channel. I'm going to change this green line to like a purple line just so we know what we're talking about here. It's actually kind of hopped back up into this channel that we were kind of trading in all year. Now, it is a downward channel, so even though the shorter term momentum in Meta is up tremendously, we are basically just kind of at the bottom of the channel here. But if you continue to see strength in these markets, there is a gap here. Wouldn't surprise me if this one can push up another $10 to $15 higher to 126, where it should meet some resistance. Momentum stays on this one. You should be able to get close back to the top of the channel on this one. The top of the channel might be closer to here, so you're looking at an area probably close to 140 on that one. That's where I would take some shorter term profits if you jumped in Meta based on just the dramatic decline on the stock. But certainly when you look at this from a valuation standpoint, under a $300 billion market cap now certainly could create some opportunities. Moving on to Apple, this one is just kind of showing where we're at in these markets. We're at a crossing road. Okay, we are making and we're talking about in the shorter term with Apple, even kind of the medium term, you're making pretty steep lower highs on this one, but you're also making higher sets of lows. We are literally kind of at the apex of where those two meet. There is some support underneath the shares at 149, but there's resistance above at about 157. Which way Apple breaks, because if you break higher on this one, you have the potential to rally back up to the top of the channel up here, maybe north of 165, maybe as high as 170. That would obviously drag the rest of the markets along with them, and probably a lot of these other stocks that we look at. If you break to the downside, you probably have very significant support down here at about 137. And if you can hold that level, that would kind of confirm another series of higher lows. But boy, for these markets to really prove that they're out of these downtrends, we've got to get above some series of highs and really close up above there. And that's a long, long ways away. Moving on to Amazon. They are finally doing some cost cutting. We like what we see, but boy, we are in a very steep downward channel on this one. It is hanging out in this box that we've had marked out here on this stock for a while, between about $80 up to about $100 per share. This is not the worst area if you want to accumulate Amazon shares. You think the cost cutting is going to be decent. You think the company is going to be able to bounce bounce back with that AWS segment. $960 billion valuation on this one. Obviously not cheap, but from a price to sales perspective, obviously less than 2 times. And so you're looking at a company with so much sales. If they're able to weed out all the wasteful spending, well, there's a lot of revenue there, obviously, that could generate profits. Finally, moving on to Netflix. This one, I mean, good Lord, it's just followed our technical pattern. I promise I was not in here earlier today tracing this out, but it actually is making a beautiful technical pattern. Okay, when we broke up over earnings, we created a little high here. We told you don't chase it at that area unless you want kind of a shorter term, kind of a momentum trade. It was going to pull back. It did that. Now we bounced off this area, came back up. Now look what we did though. We created another higher high on this one. I didn't sell it right at the top, but I told you last week I jumped in on this one somewhere down here. I sold it about halfway up. Look, it's been a rough year from a long-term trading perspective. So I'm taking profits anytime I can. Now we've started to pull back on this one. My guess is, yeah, if the momentum stays out of this stock and even the markets, you should pull back, but probably to another higher low on this one, right in that kind of 260 range that I'm going to be a buyer again there. You should have some support underneath this stock at about 250-ish. That's also an area where you probably want to get out, because if you break this kind of technical pattern, even if you break below these lows at 250, well, then you're probably coming to the bottom of the channel, which still wouldn't mean that the bullish move and the uptrend is over. You'd really have to break down on this one. That's why when you get these large moves in these stocks, boy, it breaks a lot of kind of bearish technical patterns and really just sets up a bullish one. I'm a buyer of Netflix again if it moves lower. Moving on to NVIDIA. This one looks like it's kind of petered out. I mean, it was on this, gigantic rally from the lows back, like a month ago. This thing rallied, oh my goodness, like 50%. So look, it's got to give that back. I mean, the stock is already wildly overvalued. Got to take a breath. And so what I'm thinking is we're probably going to come back down here and retest at least this area of support back here at about 130. If that area breaks, you are absolutely retesting the 112 areas, which is the 52-week low on this one. And if that area breaks, you are retesting the area that I think is absolutely possible from a valuation perspective on this stock, south of 100, more specifically, probably $75 to $80 per share on NVIDIA. Moving on to Google. This one, like NVIDIA, made a monster rally off the bottom here. That was like a 20% move in a very short period of time. Hard for stocks, obviously, to maintain that momentum. This stock is still in this downward channel. It really needs to get above this $100 level and then really kind of push above 105 to really show that there's strength. But even then, you are just running up against this kind of green downward channel where you were just making lower highs. Again, I know these rallies have been pretty good. I've been accumulating these stocks, but I just want to remind you guys, the dominant trend is still down. The dominant channels are still intact. The idea is to get fully invested. I think by the first half of next year, I am going to be fully invested by the end of this year. I don't mind jumping the gun. Knock on wood, I still got 20 years left before I've got to sell any of these stocks. I'm not trying to pick the bottom exactly. I'm just trying to get these stocks as they've been beaten up. Moving on to Microsoft, it almost beautifully illustrates the situation that we're in, very much in these downward channel. The buy zone, I think, for Microsoft is just south of where it's at. Anything south of about 235, I think, is a decent buying opportunity. We've made it halfway up this channel. This one obviously could continue to push up to the top of the channel. Look, the next week's a short week. It's a holiday week. My guess is the shorter term momentum in the markets has actually been up. So I'd actually expect the markets to continue to drift higher. Microsoft could go up another 6%. This is where you take profits. This is where you peel things off the table. You reduce risk if you want to. I wouldn't necessarily chase this stock at this area. If it gets rejected here, we should retest the 52-week lows down here at about 213. Anything lower than that, boy, great buying opportunity, I think, south of 210. Moving on to Tesla. This one is holding that 180 level, but boy, it's on thin ice. And it is in a very steep downward channel. Just like when you have kind of upper channels, we'd actually expect this one to bounce, but it just simply hasn't. The more this one goes down, the more attractive it is from a valuation perspective. Clearly, like all stocks, there is a lot of risk in Tesla, and it has a bloated valuation. But as this stock continues to pull back, you're looking at a stock with positive cash flows, no debt, and a strong growth rate, at least projected out into next year. And those stocks tend to get a premium valuation. So certainly if this one could come down to the support level down here, that would take you down to about 130 per share. That'd be another 25% drop on this one. In no ways am I encouraging anybody out there to be overweight Tesla or overweight highly volatile stocks like this, but everybody's portfolio has a little bit of room for highly profitable, highly growth stocks, and ones that if they can turn it around, even a move back to the top of the channel, confirming another lower high, would be an NVIDIA-like 50% move. And at the very least, that can create some excitement in a portfolio. Guys, hopefully you guys had a wonderful week out there. We'll see you again next week on Black Friday. Be safe this holiday weekend. Drive carefully and travel safely. Enjoy your time with your families, and we'll see you again soon. Good luck with your investments.